Thank you so much, everyone, for joining. Good morning, good evening, wherever you are. Welcome to the second iteration of our expert series. Today's a bit more special because we're now doing our private event. The last one that we did was Colin Erickson. It was a public event. Today, we have Jeremy Kim here, who's an expert in structured credit. He has tons of experience around working in credit space as well as in the general finance industry. I'll just let Jeremy firstly introduce himself before we dive into any further questions. Jeremy, please go ahead.
Sure. So I've been working in structured credit for close to 13 years. And so I started off working outside of structured credit for a couple of years. And then I started structured credit at PwC with the structured credit valuations team. So I was there for a couple of years, and then Thomson Reuters with the valuations and pricing team, and then Bank of America with the valuations team. And then I joined a credit fund that when I joined, it was a family office, and we grew it to a credit fund. So I was there for another 5 years, and then there we invested in everything from the private lending side of structured credit, but also the public QSIP bond, like the term securitization bonds as well. So I was doing that for about 5 years, and then tried to launch a startup where we applied blockchain technology to the loan data management side of structured credit, but realized that there wasn't really a product market fit because everyone wanted to use it, but no one wanted to pay for it. And then I joined and then I consulted for a couple startups, and one of which offered me a salary and asked me to work for them. So I worked for them for about a year where we were working on some tokenized securitizations. And then things happened in my personal life where I thought it might be worthwhile to shift back into TradFi while staying as plugged in and involved with the DeFi community as it pertains to RWAs. And about 3 months ago, I made the move back to TradFi, where at the Z Bank, I'm basically working with the structured credit lending team, where it's similar to, similar to what I was doing at the credit fund, where basically we're lending through asset-based lending warehouse or lending vehicles and to different borrowers, some of which are other credit funds or loan originators.
Got it. Now that you're back in, I guess, working more into traditional finance, what do you see as some of the differences are between the whole crazy fast-paced crypto environment and what you're doing today?
So I think the key difference is the culture. So right now in crypto in general, I think it's still so early that everyone has that startup mentality of bootstrapping and to some degree fake it till you make it, and basically focusing on execution like before, or basically focusing a little bit more or emphasizing more execution and traction rather than completeness and perfection. Whereas in credit, I think because the focus is on not losing money, because if you don't care about losing money and you didn't care about risk, then you wouldn't be in credit. You'd probably be in something else like distressed or equity investing or VC or private equity. So it is very much focused on, will I get my money back, and what's the likelihood of me getting my money back? And this is true for senior investors down to the more risk-taking credit funds, where even if they go a little bit more aggressive in it, their analysis is still very much focused on what's the likelihood of us incurring our first dollar of principal loss. So I'd say that's the main difference. So
I see.
for additional context, so when I was at the startup, there was a push to just onboard or just a push to try and execute as many transactions as possible, regardless of whether those transactions were high quality. And of course, there was a lot of signals from the higher up to try and cut corners, which I think in the startup space is, I guess it's fair to do because again, the focus is on traction and execution. Whereas from a credit standpoint, I think some of the deals, the way they were the way that they were starting to get structured, TradFi investors probably wouldn't touch it. And the key issue when I was at that startup was that the higher ups were pushing our deals as if they were on par with institutional opportunities, when it really wasn't. And so I think that's the key the differentiating factor is that I guess in the crypto space, inclusive of the RWA tokenization space, is that it's still so early. It's almost like the Wild West.
Yeah.
And it's just going to be natural that the opportunities are going to be a little bit more hairier and there's going to be some corners being cut. And that's just natural, I think. But I think at some point, the two sectors are going to converge and then you'll see the same level of quality of the opportunities on the DeFi, on the RWA DeFi side, and a lot more openness and willingness to incorporate new technologies on the TradFi side.
As someone who worked in both TradFi and also a couple of years in DeFi and the RWA space, I'm curious to understand why there's such a disparity, right, between the quality of loans, or rather the quality of credit and the opportunities available. Is that because in the crypto space, because it's fast paced, like you mentioned, there are certain differences in terms of culture. There's quite a lot of appetite for risk. Is that so that the crypto investors in general just have enormous amount of risk taking, even when they're investing in RWA?
I wouldn't say that's the main reason. I think it's because the TradFi market is already established. And I think this is also a reason why that I think RWA DeFi is it's gonna take a lot of effort and some amount of time for it to actually grow, which makes it great for companies like you guys to step in and I guess catch up really quickly. So basically my thought is that in TradFi, because the structured credit market has been around for such a long time, I think at least since the 70s or the late 70s. So it's been around for so long that all the functions have become so specialized and siloed that it's become extremely efficient. Now, I guess to clarify, the industry has become efficient at executing an inefficient process. So there's so many different third parties and checks and double checks that there's a lot of capital that's being siphoned out within the cash flow streams. So that part is quite inefficient, but a lot of those checks are there for a specific reason. And I think the industry has become efficient at executing this inefficient process to the point where they accepted this as the norm. So for a private credit, structured credit lending deal, for example, it could take anywhere between a month and a half to 6 months to close. Or for a term securitization, it could take anywhere between 3 weeks to 6 weeks to close. And I think people the people in the industry or borrowers and investors just accept that this timeline is the norm. And so I think so what you end up having are a lot of potential high quality borrowers who look towards TradFi and see that they can access credit through TradFi. But then they see DeFi and they see an opportunity to access credit that might be a little smoother, but then there's also additional risks like regulatory risk or most importantly, the stickiness of capital. And then from the investor's perspective, there's also additional aspects of whether they get their money back. Because when it comes so basically there's two sides, and maybe we take a step back and just looking at like the agenda, I think a lot of this could be explained just by, or addressed by explaining how structured credit works. So basically, structured credit is a subset of private credit. So private credit is a broader umbrella term that includes a bunch of other things like direct lending, which is the next evolution of I guess like LBOs and whatnot. And then there's structured credit. So structured credit, the basis is essentially you've got borrowers and you've got people with capital, and the borrowers are seeking capital. And the concept is that with the borrowers, that they have some sort of asset that they can monetize. And usually it's some sort of cash flowing asset. Sometimes it isn't, but more often than not, it's got some sort of cash flow that they can either model out or project and build some sort of pro forma model And so what they try and do in the structured credit type deal is to basically monetize that. The easiest way to do that is to sell those assets. But then the challenge though is matching the needs of the investors with the opportunity. So this is where the banks come in, and the banks are basically almost like the matchmakers. So they can come in, work with the borrowers, look at their assets and say, these are cash flowing in this way. And we have all the contacts at these different investment funds. And we know what each of these investors, what sort of risk appetite they have. And so what they can do is take those asset cash flows and basically slice and dice them in a certain way where it basically allocates the risk and the appropriate risk and return for each investor. And so that's effectively what's happening in a structured credit transaction, that you've got lenders and you've got lenders / investors, and you've got borrowers in need of capital. And so going back to your question, so when it comes to borrowers, they don't care, or at least like the higher quality borrowers, their business is typically to originate loans and lend to their borrowers and then get their money back. And then from the perspective of the lenders and the investors, their business is to deploy their capital from their LPs or from wherever they're sourcing their capital, and to basically make sure that they get their money back and then some return on top of that. And so when it comes to integration of technology, like the higher quality, or I guess not higher quality, but the more established lenders that would be able to execute a large scale structured credit transaction on some sort of a like DeFi platform, they typically have access to the TradFi markets. And so they're not necessarily incentivized to seek capital exclusively from DeFi. And then ultimately what ends up happening is that because to them, DeFi is a secondary potential source of capital, they don't really focus, or they're not extremely motivated to get things done. And so what ends up happening is so effectively there's some degree of negative selection where you'll have borrowers that find a lot of difficulty getting access to capital through the TradFi markets, turning to the DeFi markets as a workaround. And so that's where the industry is now. And it's not saying anything bad about, I'm not saying anything bad about the DeFi space, because it's basically like, I think SPACs were similar, where early on SPACs were effectively had that sort of branding, that the types of companies that weren't able to IPO because they just weren't as good would go to SPAC round. And I think that was mainly because at the time the SPAC was a new product. But then I think over time, I think people became a little bit more educated about SPACs and became a little bit more open to investing in SPACs. And it's just unfortunate that most of the SPAC transactions were tech heavy and then highly sensitive to interest rates. But I think it's shown that SPACs became like an alternative approach to IPOs, and also the investing public became a little bit more educated on what to look out for. So I think it's similar to in that front, where it's still so early that it's just natural that there's going to be some degree of negative selection as the space grows.
Yeah, I think it's really just about the matter of time, right? Eventually, as the technology proves itself out, hopefully people are going to start seeing the benefits and the incentive, and receiving the incentive to actually deploy and use the technology as a primary source, right? I'm not saying that, to be honest, I don't really like to use the word DeFi or real world assets, etc. To me, it's all just technology enabled solutions to make something that's inefficient a bit more efficient. It seems that just that the market currently has no incentive to improve some of these inefficiencies. As you mentioned, they just became very efficient in executing these inefficient transactions, right? So I think it's really just a matter of time until we reach a saturation point where this becomes the norm again. Then everyone can be on this technology without having to go through this negative selection process.
Yeah. And I think I'll caveat that as well by saying that like my experience and understanding is specific to the US markets. And
Yep.
so I think where platforms like you guys and other platforms like Goldfinch and Credits are finding a lot of opportunities are in the like outside of the US markets, where the US markets, the infrastructure is so well established that, like we were saying before, that the potential borrowers and investors have already accepted that they accepted the inefficient process as the status quo. Whereas in
Right.
a lot of emerging markets, there isn't much of a deep
There's no
structured credit
legacy.
market in place.
Yeah.
Yeah. And so in fact, I think I've seen a lot of opportunities when I was at the credit fund from from emerging market potential borrowers, simply because they like the types of institutional TradFi bar or lenders in their market, their home markets, just didn't understand it enough. And naturally, when you in TradFi in finance, when you don't understand the risk, the tendency from a credit perspective is to go hyper conservative. And so that means a
Right.
significantly low advance rate and a high interest rate. And to the extent where it might be even detrimental and prohibitive to the borrower's business. And so I think a lot of borrowers have from the emerging markets have tapped into capital sources in more established markets. And so I think because of that sort of a lack of a deep established credit market
Mhm.
specific to structured credit, I think there's that opportunity for RWA DeFi platforms like you guys to actually deliver value.
Yeah, I think it's also interesting, right? Because especially in our part of the world, it's not only the access, but also the education and the knowledge required to understand this asset class. It's a fairly new asset class altogether for for borrowers as well as for investors. We're also doing quite a lot of work in terms of helping investors understand this asset class, like this very webinar that we're doing right now. But I think there's a lot more work to be done as an industry to continue evolving because as you mentioned, this is where the opportunities are because there are no legacy existing inefficient processes to solve for. So it's really just a matter of getting people be aware of this as a class, getting people excited about it, and demystifying some of the, I guess, misunderstandings around this as a class. So with that, actually, we've been talking a lot about structured credit, but we haven't quite talked about how this structuring actually happened. Can we perhaps dive deeper into that? So how does structuring happen in some of these deals? Who are the parties involved in the structuring? What are some of the considerations that you've seen that gone into structuring?
Sure. So going back to what I was saying before about borrowers matching with investors and lenders, it's going to be like almost 100% driven by like the structure is going to be the structuring aspect is going to be almost 100% driven by the needs of the investors and the lenders. So basically, so essentially, if the simplest way for a borrower or like a capital seeker, I should say, because they wouldn't
Mm.
always be borrowers. Because sometimes they'd be sellers, they're sellers of assets, sometimes they'd be borrowers, sometimes they'd be issuers of bonds. And so I think I'll call them seekers of capital. So these capital seekers basically, they just want capital. They don't care as much about what infrastructure they're going to use or what sort of structure they're going to build out to basically access this capital. They just want the capital. They just want access to. They want a couple of things. So they want access to capital. They want certainty that the capital is sticky and is going to be there, and then they want a level of the cost of that capital to make sense given whatever assets that they originate. And those are the three core wants and needs of or I guess maybe it's needs, wants or
Mhm.
needs of the capital seeker. The capital provider, the wants and needs will differ with each capital provider. So for banks or even like insurance funds, their sourcing of capital or I guess taking a step back. So this for the capital providers, their needs and wants are going to primarily be dependent based off of where they're sourcing their capital. So banks and insurance funds, they, because of how they source their capital, their needs are, or their needs and wants result in a very low tolerance for risk and almost a fairly low like return requirement. And so typically like these would be so when it comes to structure, so if the capital seeker, if their assets, let's say this capital seeker is actually let's say a loan origination company that originates 3-year loans that charge like unsecured consumer loans that charge 20% with a 10% default, like lifetime default. So just as an example, so for capital seeker or capital providers like banks or insurance companies, that level of risk just to buy the assets would be a little bit too much for them. And so what would end up happening is either the capital or sometimes the capital provider will say, we want to carve out a portion of that risk so that we won't take the full upside. So in that scenario, for the unsecured consumer loans that the capital seeker is originating, the net return would be, let's say 20%, because if it's, or no, it'd be 30%. So no, if it's a lifetime, yeah, it'd be 50%. So if it's a 3-year loan that's paying a 20% interest rate, but then you've got a lifetime default rate lifetime defaults of 10%, then it should roughly shake out to about 50%.
Yep.
So what ends up happening is the capital provider will say, we don't want that 10% exposure to default. We want some protection from that exposure. But in return, we don't need the full 50% of returns. We're happy with just taking, say, 10% returns. And so basically that's where the structuring aspect comes in. So it's basically a contract between the capital seeker and the capital provider to say that we'll backstop or not backstop, we'll pay you this much, we'll pay you X, which is a certain percentage of the total cash inflows. But then as losses come in, you won't be required to, I guess, share those losses until the losses reach a certain dollar amount. And so that's where the basis of the structuring aspect comes in. And then naturally with other investors like credit funds, where they're a little bit more open to taking on risks, they might structure it a little bit more aggressively, or they might just buy the assets outright. So I think there's different, and then that depends on where they're sourcing their capital as well. So I think it all depends on the capital providers and where they're sourcing their capital and what their risk and return appetites and hurdles are.
In these processes, you mentioned a lot about risk and return requirements, right? So I'm curious to understand more about who actually goes in and structure these deals, because it sounds to me like structuring effectively is very much a repackaging of risk and return so that the capital provider and the capital seeker can find a compromise to make sure that the capital from the provider can then be routed through the seeker efficiently. So who is actually sitting in the middle, calculating all this credit risk and making these decisions or making this repackaging decisions?
It depends. So basically for certain deals, we call them bilateral deals. So it's where the capital provider and the capital seeker connect directly. And then they basically, I think the more accurate way is that the capital provider is the only provider of capital. But maybe that term is too specific to lending. Or I guess just to answer your question. So there's certain scenarios where the capital provider will do this, I guess the quote unquote structuring, or at least the first step. And usually the way it starts is that the capital provider will ask the capital seeker for, let's say, historical data on the performance of their assets. And then based on that performance, they'll basically give indicative terms to say, here's what we're thinking based on our risk and return appetite and hurdle. This is what we're willing to provide. And then they'll be the first step in providing that structure. And so from there, it just becomes a negotiation between the capital seeker and the capital provider. So what I was saying before about where the banks come in. So sometimes the capital seeker and the capital provider might have some trouble connecting and finding each other. And the bank will come in as a middleman and connect them for you. And sometimes the bank is there to tell the capital seeker to basically bring them back down to earth. So maybe the capital seeker thinks that they can get very favorable cost of capital or like a lot of capital for very cheap, but then maybe given the assets and the market, the bank might bring them back down to earth and say, actually, the market isn't going to be, a market doesn't match what you think it is. And they might work with them to come up with a structure that would make sense. And so that there's that, but then like you have to take also another step back and understand the different stages of structured credit. So I think the simplest way to put it would be that there's three approaches to different structured credit transactions. So the first is a flow purchase. So that's the sort of agreement. So it's basically the legal document is basically a purchase agreement between two parties where the capital seeker and the capital provider will agree that the capital seeker, based off of whatever originations that of the assets that they create, that they're going to sell on let's say a monthly basis to the capital provider at a predetermined price up to a certain date and or a certain dollar amount, that they would buy anything and everything that fits within a certain eligibility criteria. So that's a flow purchase transaction. So the second type of transaction is a warehouse line. Essentially, it's an asset-based revolving warehouse line where a capital seeker basically says, we have these assets and we're gonna continuously originate these assets, and the capital provider will say, we'll lend you X% for every dollar of assets of every eligible asset that meet our criteria, we'll lend you X% of each dollar. And so let's say if it's the advance rate is 70%, they'll lend, let's say 70 million for every $100 million of eligible assets. And so that's the second type of transaction. The third type of transaction is a term securitization. So where the capital seeker and the capital provider are almost, and I think this is where middlemen like banks are almost like 99% of the time present and actually doing the structuring transactions and allocation. So this is when they basically tap into a different source of investor base to say, we just want to get leverage on these assets. We don't really need a revolving line, or maybe we do need a revolving line, but we just want like a fixed source of capital where we don't have to worry about amending the terms or basically doing other things. And oftentimes these sort of term deals are structured in a way where they can just put in the assets, and the assets, as they pay down, will take care of the interest expenses by themselves. So, and oftentimes, I think initially the term securitizations were, I guess the more common structure is that these are static pools where, again, these capital seekers will structure a pool of loans in a way where the loan, or like this, the bond on the deal, will pay down as the loans, underlying assets themselves, pay down. And that pool of investors are very different than the first two. And so I think you have three different avenues within structured credit. So going back to your question, so who's doing the structuring? So when it comes to the first two, it's almost always the capital provider initiates, and then it becomes a conversation between the capital seeker sometimes there is a middleman, but usually the middleman makes the introduction and then steps back and then allows things to happen. Whereas in the third avenue, the term deals, the middleman will get a little bit more involved and actually do the transaction, do the structuring, will be the point of contact for the rating agencies, and will basically find the investors for the capital provider, or no, the capital seeker, I should say.
Mm.
This goes back to what I was saying, how the like sometimes it's the investor, sometimes it's the lender. So
Right.
in the first avenue, the capital provider would be considered the buyer, because it's a flow purchase agreement where they're buying the assets. And the second is where the capital provider would be the lender, because it's a warehouse facility, it's a warehouse loan facility, or a revolving loan almost. And then the third is where, so I guess in the first one, the capital seeker is the seller, the capital, and the second one is the borrower. And then in the third one, the capital seeker is the issuer. And then the capital providers are the investors.
Yeah, that's super interesting. You mentioned earlier just now about the usage of rating agencies. Are these most commonly found in term securitization types of structured credit, or are they also found in the other two types?
Probably not in the first type. The second type, sometimes, again, rating agency involvement is almost always dependent on the needs of the capital providers. For instance, insurance companies are willing to provide capital for pretty cheap, but they have very specific requirements. And one of which is that they, like, whatever opportunity that they invest into needs to be rated. And so in that sense, like, the provider of capital is the driver of the necessity of a rating, and not so much the capital seekers thinking, if we get this rated, we'll get better execution. It's usually more they connect with someone, and then that someone tells them we can invest or we can lend, but it has to be rated. And sometimes in the third avenue, the bank, the third party, the bank might tell the capital seeker, we have these investors lined up and we're certain that they're going to be interested, but you have to get it rated. And so they might preemptively set up a rating, knowing that the ultimate capital providers, the investors, are going to need one. And so I'd say it's usually driven I'd say it's the need for a rating is usually driven by the capital providers, but the relationship ultimately goes to the capital seeker, because it's a capital seeker that's going to be providing the rating agencies all the relevant asset level data. Yeah.
But in terms of commercial, I guess, relationship, I'm just curious, does the rating agency charge the capital seeker or the capital provider?
They typically charge the capital seeker.
Interesting.
Yeah. And so I think that's why I feel like the rating agency model is a little bit distorted, because it's very much pay to play. Now, that being said, I think with everything that happened in the financial crisis, I think it was absolutely pay to play back then, where you could basically buy your way into the rating that you wanted.
Exactly.
But these days, I think because of the financial crisis, the rating agencies skew significantly conservative, because they don't want egg on their face again. And so I think there is a line that they would draw in the sense of actually coming up with a rating that would make sense. But that being said, I think what ultimately happens today is that the structure would, again, more based off of what rating they would need. So in the third avenue, for example, if the capital seeker, or let's say if one of the capital providers said, we absolutely need a rating on this, and then the capital seeker it was clear that the capital seeker didn't have any other options, then what they might do is either the capital seeker or the intermediary, the bank, might restructure it so that there's less risk going towards the capital provider that needs that rating. And there might be changes to the structure to target a specific rating, but that getting that specific rating is almost always motivated by addressing the needs of a specific capital provider.
What I find interesting is really just that misalignment of, or rather conflict of interest, I would say, right? Because they're there to basically serve the needs of capital providers, yet they're paid by the ones, who capital providers require clarification from. So I thought that was interesting. I didn't know that was the case.
Yeah, yeah. And I think it's an interesting situation where
Yeah.
it's hard to do it in different ways. But I think this is also one of the interesting ways that I think, or one of the interesting opportunities that I think RWA DeFi can address.
Could you elaborate further on that? I think there's something interesting there.
Yeah, so I think this is something that a lot of RWA platforms are trying to work through, but haven't figured out the best approach. Like, for example, Centrifuge has the credit group, and then Goldfinch has a credit grant.
Yep.
But ultimately, these are all third parties. And I guess full disclosure, I'm part of the Centrifuge credit group. But ultimately, these are like third parties that are providing some sort of perspective. And so I think you ultimately end up back with this problem of, are these guys compensated? If they're compensated, then are they really motivated to portray the risk and return accurately? So I think this is my personal perspective. I think that the path, like the actual path forward that I see for ending the existing rating agency structure would be to figure out a way where the capital seeker compensates the capital provider for sharing some of their analysis to the other capital providers. Not sure if that makes sense. Where let's say if you have an anchor investor, and the deal is structured where you have, let's say a 7%, or these days 7% is quite low. So let's say 10 to 12, let's say like a 10% return. But there's an anchor investor, and let's say like 50 other smaller investors of various sizes. I could see a scenario where if you were to structure it in a way where let's say the anchor investor shares some of their analysis, and you structure you build the infrastructure in a way where the other investors can pay part of their 10% return to basically allocate that return to juice up the return of the anchor investor or the investor providing the analysis. And then on top of that, the capital seeker pays a little bit more for the anchor investor to provide that analysis. I think there's a way to incentivize one of the investors to share that analysis. Of course, this is oversimplifying everything.
Yes.
You also have to think of a way to make sure that, because again, the challenge here is that you have the potential of an investor basically talking up their book, which basically means they invest in something and they pretend like it's better than it actually is to get more investors into it. And then if they actually don't feel like they want to stay in it, then they could exit that investment. While staying internally, they can say, we don't like this investment, we're going to start offloading the risk, but then publicly say this is a great investment. But I think there's got to be some sort of structure where they get that additional upsize from the upside from sharing that analysis. There's got to be some sort of structure for that to be clawed back. But again, I think I think there's a lot of people thinking about this, but no one's actually cracked the code or actually executed successfully. Right. But yeah, this is just one of the factors that I think could be improved on.
Yeah. That's quite interesting, actually. That reminds me of the whole angel syndicate model, right? Where the lead angel will basically publish his or her thesis on why he or she is excited about a certain deal. And the rest of the syndicate can decide whether they want to follow that or not follow that. And I believe some of the lead angels actually charge a carry for that if the deal were to go through.
Okay. Yeah, that's interesting.
Yeah, it's quite a similar model, but there's always room for fraudulent activity, right? So even in the thing about angel investment though is that it's rather difficult to offload some of these assets. It's rather illiquid. So you don't have a situation where the bigger player could easily offload their portfolio to others. But I presume for private credit and structured credit specifically, it's a little bit different.
Yeah. And I think the other thing is the investment time horizon. I think for
Yeah.
VCs, time horizons probably close to 10, 20 years, right?
Yep.
But I think with credit, I think typically the time horizons are a little bit shorter. And also because of the way that data is made a little bit more available, like the way that data infrastructure and technology has improved both on sourcing the data and managing the data and analyzing the data. I think a lot of capital seekers and capital providers are hyper focused on data. And so when it comes to credit or like structured credit, I think it's not sufficient to just produce a report that says here's our analysis. Then, or it's not enough to produce a report at the initial onset and say, here's our analysis and here's our thesis why we think this is a good investment. I think
Yeah.
there's a need for subsequent reports to show here's how it's performed and here's why we think it's still a good investment. So on that note, if you were to map it to what rating agencies do, they do the same thing. So they'll come out with an initial rating report, and then every month they'll get the remittance reports from the investment opportunity that they're rating. And then typically I think typically once every either quarter or every 6 months, depending on the contract between the capital seeker and the rating agency, they'll produce some sort of surveillance report, or sometimes they won't produce any surveillance report until something material happens.
Yeah.
But basically the rating agency puts out surveillance reports to basically show we're keeping an eye on it. Sometimes they upgrade, sometimes they downgrade, sometimes they reaffirm, which basically says like the credit still is the way we saw it when we first looked at it. So there is the idea of a surveillance report within TradFi, and I think that's going to be just as important in any kind of applications of third-party ratings when it comes to RWA DeFi as well.
Yeah. That's super interesting, actually. That reminded me also of this company called in the US called Percent. I'm sure you've come across them before. I think they're specializing quite a lot in building that infrastructure out, especially for capital seekers to then start publishing some of the surveillance reports and also for underwriters as well. Honestly, did not really quite understand why they were doing that, but based on our discussion today, it's a lot more clear to me that there hasn't been any infrastructure that's built around surveillance and monitoring and communicating the changing risk environment to I guess the larger capital provider. I guess what they're doing is really just building the infrastructure out to make it more efficient. So that makes a lot of sense. I don't think
Well,
I've actually seen anything.
just to
Sorry.
caveat that, I think the
Yeah.
surveillance report you're referring to at Percent is different than the surveillance report that a
Oh,
rating agency produced. Just for additional context, so I know the Percent guys fairly well. So when I was at the startup, we actually got onboarded as an underwriter. And so we were pretty familiar with the platform. So I think when it comes to, so ignoring rating agencies for just a second.
yeah.
So once a deal, so typically any one of the three avenues that we were discussing earlier, once the deal gets done, there's usually some agreement that there's going to be some ongoing reporting of how the underlying collateral is performing and what assets got added or what assets got taken out, what cash flows were produced from the assets, and from those cash flows, indications of how they allocated the cash that was collected. So that's typically called, depending on the type of deal, it's either called a remittance report or a barn-based report. And so these typically happen on either a monthly or a quarterly cadence. And so the way that TradFi does these now is through so for the first two avenues or the first two types of structured credit deals, it's usually the capital seeker that basically does it. And usually the capital provider will work with the capital seeker to say, this is the type of reporting we want. Or sometimes they'll just send them a template and say, just fill this out. The third type of transaction, and sometimes the second type sometimes the first two, but almost always the third, you'll have an external third party administrative or like admin agent or a trustee to basically be a independent third party that does all of this and tracks all of this for you or for the investors and the borrowers. And what's happened in the TradFi world is that there's these sort of technology-based solutions that try and automate this process, because ultimately the types of third parties that are doing this act almost human smart contracts where they don't analyze anything. They're just given a set of waterfall. They're given you a legal waterfall, a priority of payments where they go in, they look at the bank account, they map from the bank account, like where the cash was coming in. They make sure that the cash from that bank account gets allocated to the right counterparties, and they produce a report showing here's how we allocated the cash. So no analysis, just checking, basically tick the box, like making sure that it goes in the right places. And so I think there's a couple of platforms that are trying to automate this. So one of them that's doing it with blockchain is Intain. And then another one that doesn't use blockchain, at least not publicly, but effectively does basically they work with an internal database, which is effectively like having a private blockchain, but without the block elements, I suppose. Another one, like that company is called Finley. And so they basically, if you look at the website, I don't know if it's still there, but they basically say that they're the central source of truth, which you would hear a lot with blockchain.
Yeah.
But the way they do it is that they're just one big database. And then there's also a couple of other platforms, and this is where you were talking about the Percent platform comes into place. Percent initially wanted to be that matchmaker between the capital seekers and the capital providers, but I think at some point they shift their focus to be more of a technology platform that basically automates the whole process, not just the connection, like the connecting, not just the matchmaking part, but allows like companies, seekers of capital just to plug into their platform, and then providers of capital to know that because they've plugged into the Percent platform, that the capital seekers plugged into the Percent platform, that the surveillance reports are going to get produced on either a daily, weekly, or monthly basis, and that they have some sort of comfort that that data in those reports are going to be accurate. So I think that's their positioning. Now, that being said, that's different than a rating agency surveillance report. So those remittance reports will still be ongoing. The rating agency surveillance report is typically done on some sort of a regular cadence, but not as regular as, say, monthly or quarterly. Or sometimes it's quarterly, sometimes it's half a year, or sometimes it's annual. But a little bit less frequently, I guess, is the key operative term. But also, it's not focused on how cash gets allocated. It's very much a presentation of their opinion on the credit risk. Whereas the surveillance reports produced by Percent and like the remittance reports that are done and tracked by the trustee banks, those have no indication of opinions on credit. It's purely factual. Like X number of dollars came in. Yeah. X number of dollars came in, and this is how those dollars were allocated. This is the balance of all the assets, and here at the beginning of the period, and here's the balance at the end of the period, and here's how it changed. And they don't indicate, we think this trend is going this way. It's purely factual, where we calculated this because this is what we're told to calculate. And so from there, it's on the capital provider to make their analysis based off of that report.
I see. Thank you. I'm aware that we're running out of time as well. I'll ask the last question and then we can wrap this up. Maybe I'll open the Q&A to the floor for about 2 to 3 minutes for one question. If anyone in the audience has questions for Jeremy, now is a great time to prepare them. I ask him. Last question. Jeremy, so going back to this whole credit and the recent trend about the whole credit space getting emerged as an interesting asset class for investors, including passive investors, how should one go about understanding this? Because it's taken personally me quite some time to understand, and I'm only just scratching the surface. What will be the advice that you would give to aspiring passive investors like me who's interested in the space?
So I think the challenge is that for people allocating a portion of their assets to this strategy, there's no way for them to gain the level of expertise that someone who works in this space full time would. So I think the key thing would be to have an understanding of the broader economy as a whole, and then how that would actually relate to the different investments that these guys would do, that you would do. And so I think what ends up happening is a lot of these sort of passive investors, or these investors who work on something different, but then allocate some of their assets to credit. Like they typically, what I've noticed, tend to look at just the yield, and they'll see, oh, this is a really high yield, so I'll just allocate it to the highest yield I can get. But I think it's important for them to understand why the yield is high or why the yield is not high, and then start asking questions. And this is not just specific to the DeFi space. I think even in TradFi, you see the same sort of trappings. So like in the REITs and the BDC space, and I guess the MLPs as well, or any kind of stock with an extremely high dividend, I think you'll find that there's a lot of retail interest. And a lot of these people will allocate money to whatever generates the highest dividend yield. But typically the dividend yield is high for a specific reason. And so I think it's important to know and understand why that return is as high as it is. And I think it's going to be definitely hard to try and replicate the work that, let's say, a full-time TradFi analyst would do. But I think at the very least, at a high level, if there's some sort of aggregated reporting, or just knowing that the concept of reporting exists, then you could ask, can I take a look at the reporting? And then you could look at it from a high level, or maybe someone else had done the analysis on the reporting and then produced their analysis. Then you could read what they produced. So I think trying to educate yourself on the different structures and the underlying risks and how it relates to the economy or specifically the relevant economies, I think is important. Because at the very least, if something happens in the relevant economy where you anticipate that there might be a risk, you can, instead of trying to do the analysis yourself, because you might be, during the day, you might be like, let's say a dentist or working at a Web3 company and not a credit investor. At the very least, you could send the question out to either some of the investors on, let's say, a forum, or directly to the capital seeker to say, hey, I'm a little bit concerned about this thing in the economy. What are your thoughts? Usually there's someone there at least from the capital seeker perspective, there should be someone there to address those questions. So in TradFi, the way that's done is basically through analyst calls. There's usually through analyst calls and through investor relations. So through analyst calls, usually the third party analyst that would analyze these different stock opportunities, basically they'll have these questions every quarter, and then the company itself would basically do this presentation to report on what the status is for that past quarter. And then the analyst will ask questions, and then this will be the transcript, and the recording will be published, and individual investors can listen to and read this. The challenge with private credit and structured credit is that it's not common for that to be readily available to retail investors. And so I guess the first step would be for retail investors or not just retail, but for the non-credit focused investors that are allocating to credit, to just ask for this sort of reporting and for this sort of analysis.
Yeah, appreciate that. I think we're also Bluejay team here is also thinking along the same lines. We're trying to figure out ways in which we can create, I guess, a direct and open communication between these passive investors as well as, I mean, between the passive investors and the capital seekers. I guess the other thing is really for passive investor is the understanding, right? Being able to ask questions is one thing and knowing exactly what to ask is another thing. I appreciate that not all investors may have similar knowledge around how to read some of these reports. So we're also trying to figure out ways to help these investors ask questions and better questions. I think we're out of time. So if anyone wants to ask a question to Jeremy, now's a great time. I think we have 2 minutes, so perhaps we can do one question. Okay. I think if there are no questions, thank you so much, Jeremy, for joining the call, especially on a Sunday night. Really appreciate it. And we look forward to doing this again. So stay tuned.